Welcome to BookLeesh, where we dive deep into the timeless wisdom behind the world's greatest books. Today, we're unlocking the secrets of common stocks and uncommon profits by Philip Fisher, a book that changed the way investors think about growth, quality, and patience. If you want to learn how to spot truly exceptional companies, avoid costly mistakes, and build wealth that lasts decades, you're in the right place. So settle in, because what you're about to discover could transform not just how you invest, but how you see the market itself. Let's get started. It began not with a crash nor a boom, but with a quiet curiosity, a question whispered in the minds of men who no longer wanted to gamble blindly with their money. What really makes a stock worth buying? The market, in all its noise and frenzy, had always praised the sharp and the swift. But behind the scenes, a different kind of investor was watching. One who wasn't dazzled by quick numbers or shiny tickers. One who wasn't interested in the noise. His name was Philip Fisher. He didn't look for the cheapest stock. He wasn't searching for short-term wins. He searched for greatness. Not the kind that flashed on CNBC or blared in headlines, but the kind that grew slowly and surely behind closed office doors, inside labs, in the minds of driven teams building something that could last. It was in this silent pursuit that Fisher laid down what would become one of the most influential investing philosophies of the 20th century. But he didn't start out as a legend. In fact, he almost walked away from it all. Early in his career, the Great Depression made investing feel more like a death trap than a profession. Friends lost everything. Trust in Wall Street had crumbled. He could have chosen safety, but instead, he did something rare. He leaned in. Not recklessly, but deliberately. He asked, what do the greatest companies do? What do the worst hide? And how can an outsider like you or me learn to see the difference? As he began studying businesses, not just stocks, something strange happened. He stopped looking at balance sheets as the end game and started seeing them as just the beginning. The real story, the story that determined a company's fate, was found elsewhere, in conversations with suppliers, in how a firm treated its people, in how relentless it was about improving its products, and whether it had the courage to make uncomfortable decisions in the face of stagnation. And that's where it all changed. Investors for decades had been trained to look at numbers. Fisher told them to look at people, to listen, not just analyze, to think like an owner, not just a trader. He developed a method so unique, so deceptively simple, that many dismissed it at first. It became known as the scuttlebutt technique. Talk to everyone, former employees, vendors, customers, even rivals, and gather the truth that no spreadsheet could reveal. It was this on-the-ground intelligence that separated good investments from traps dressed up as bargains. And what he found was shocking. Great companies rarely screamed their greatness. They didn't need to. They simply delivered, day after day, year after year. And the ones that would quietly outperform the market, they were often hidden in plain sight. They weren't cheap. They were right. But convincing investors to look beyond the price tag was no easy task. Wall Street was still obsessed with immediate returns. It was addicted to speed. Fisher's message? Slow down. Listen longer. Buy less, but buy better. He would come to define what it meant to invest in quality. His book Common Stocks and Uncommon Profits wasn't just a manual, it was a warning. A warning that chasing the crowd would never lead to wealth, and that short-term wins could destroy long-term gains. In this world of endless choices, he told investors to ask 15 powerful questions before touching a stock. And each one cut deeper than the last. Not just, is this company profitable? But, can it dominate its industry? Does management think in decades or quarters? Do they have the guts to kill a product that no longer serves the mission? Can they take criticism? Will they still be relevant in 20 years? Most companies failed the test. And that was the point. Fisher wasn't building a portfolio. He was building a legacy. He was crafting a toolset for those who wanted to own pieces of businesses that shaped the future. Not through hype, but through substance. Through innovation. Through integrity. The world changed around him. Wars, recessions, political chaos, but his method never did. It was timeless because it was rooted in reality, not predictions. And the reality he saw was this: success in the market isn't about speed. It's about understanding, about seeing what others miss and having the courage to stand alone until the world catches up. And yet, even for Fisher, there were moments of doubt. He watched as the investing world drifted back towards speculation, as bubbles inflated, as shortcuts seduced even the smartest minds. There were times he wondered if people truly wanted to invest wisely or if they just wanted to win fast. But those who listened, those who truly applied his teachings, found something rare. Not just profit, but peace, confidence, the kind that comes when you know what you own and why. The kind that doesn't waver with market crashes or headlines. The kind that builds not just portfolios, but futures. This is the story of that method. And the story of the man who refused to trade wisdom for speed. Part 2. The most dangerous investment is the one that looks safe. The company that's loved by everyone, that hits the headlines, that posts quarterly profits like clockwork, those are often the very ones that escape scrutiny. And this is where Fisher begins to dig deeper. Not into what looks good on paper, but what endures in practice. He wanted more than surface numbers. He wanted to know, how does the company treat its employees? How fast does it innovate? How does it handle mistakes? These weren't trivial questions. They were the soul of the business. And so, he gave the world his famous checklist, 15 qualitative points to examine before buying any stock. But this wasn't just a to-do list. It was a map, one that separated rare excellence from manufactured success. The first few points are deceptively simple. Does the company have products or services with enough market potential? Is there room to grow? That's where most investors stopped. But Fisher kept going. He asked, what is the company doing today to ensure it dominates tomorrow? And this was the turning point. Because many companies had potential, but few were actively chasing it. They were too busy defending their past to build their future. Fisher knew this. He understood that success wasn't about what a company had achieved, but whether it could reinvent itself again and again. He looked at research and development, not the amount spent, but how intelligently it was used. He studied leadership. Were they transparent? Were they visionary? Or were they just riding momentum? He watched how businesses handled adversity. Did they pivot or panic? Most companies faltered under this lens. But every now and then, he found one that shined. A company that didn't just talk about vision, but built it day by day, brick by brick. That's where he placed his bets. And those bets, over time, proved extraordinary. But it wasn't always smooth. The market doesn't reward patience immediately. Fisher would invest in a company and hold it for years, sometimes watching as it lagged behind flashier names. Friends questioned his strategy. Critics mocked his slow, methodical pace. And yet, he held on. Because he knew what others didn't. The true value of a company is revealed not in days or months, but in decades. He didn't just want a return. He wanted to own a piece of greatness. But there was a cost. The market loves drama. It rewards movement, action, noise. Fisher's way was quiet, careful, often misunderstood. He urged investors to concentrate, not diversify blindly. To know a few companies deeply rather than many poorly. That advice flew in the face of conventional wisdom. But it made all the difference. And then came the turning point, an investment that would prove his philosophy. It was Motorola. Fisher had been following them quietly, long before they became a household name. He saw something few others did, not just a technology company, but a culture of relentless innovation. Engineers who pushed limits, leaders who listened, a vision rooted in the long term. He invested and held. And as Motorola transformed the world of communication, Fisher's return soared. Not because he timed the market, but because he understood the business. That's what he was trying to teach all along. Not how to pick stocks, but how to think like an owner, how to look past the noise, how to tune into the heartbeat of a company and decide, is this something I want to partner with for the next 20 years? It was never about chasing trends. It was about spotting enduring traits. Traits like customer loyalty, innovation, ethical leadership, intelligent risk. These didn't flash on a chart, but they built empires. And through it all, Fisher kept warning against one thing: the temptation to jump ship, to sell too early, to trade for the thrill. He believed the biggest mistake investors made wasn't buying the wrong stock, but selling the right one too soon. His advice? Don't trade. Don't chase. Don't overreact. If you've done your research, if you truly understand the business, then stay the course. Because in the end, wealth isn't made in the buying. It's made in the holding. Part 3. The irony of great investing is that it often feels boring. There are no bells, no sirens, no dramatic countdowns. It's a slow march, not a sprint. And for Fisher, that was the whole point. If an investment excited you too much, if it demanded constant attention, if it pulled you into headlines and hysteria, it probably wasn't the kind of company that built generational wealth. True greatness, he knew, was found in businesses that worked quietly, behind the scenes. While the world was distracted by the latest fad, the best companies were solving hard problems, delighting customers, and improving their systems without needing applause. But most investors didn't have the patience to wait for that kind of success. They wanted fast results. And when the market trembled, they fled. It was in those moments, the panic and the uncertainty, that Fisher's approach became a fortress. He urged investors to build deep conviction, not through faith, but through facts, gathered, tested, understood. He wanted investors to do what few others did: talk to the people closest to the company, the ones who saw it not as a symbol, but as a living organism. How did suppliers describe the company's ethics? Did customers feel loyalty or just satisfaction? Did employees talk about leadership with pride or with fear? This scuttlebutt method became legendary. It turned average investors into silent detectives, gathering whispers, clues, insights. Not numbers from a Bloomberg terminal, but truths from the people who actually interacted with the business. And slowly, a pattern emerged. The best companies weren't just innovative. They were obsessed with improvement. They didn't tolerate complacency. They constantly refined. They welcomed criticism. They invested in talent. They admitted mistakes early, and they solved them. But finding these companies wasn't enough. You had to recognize them when they were small, when they weren't obvious. That's what separated Fisher from the crowd. He didn't wait for Wall Street to validate his choices. He acted when the evidence, not the emotion, pointed toward long-term strength. And yet, this was also the hardest part, because long-term strength doesn't reveal itself in the next earnings report. It shows up in quiet, incremental progress. And that requires belief, patience, vision. Many failed that test. They bought great companies and then sold them at the first sign of doubt. They panicked during downturns. They chased the next hot thing. They didn't realize that wealth was being quietly built, not in dramatic leaps, but in consistent execution. Fisher called this the power of the holding period. Once you find excellence, your job isn't to trade it. Your job is to honor it, to partner with it, and yes, to endure its bad seasons without betraying your thesis. Because even the best companies stumble. The market overreacts. Fear creeps in. But it's in these exact moments that discipline is tested and wealth is forged. One of Fisher's most repeated insights was this: selling a great company because it's no longer cheap is like divorcing a loving spouse because they aged. It's a shallow, short-sighted move. True greatness matures, and the longer you hold it, the more it gives you. But to hold with confidence, you must understand what you own. That's why his 15-point checklist wasn't just about screening companies. It was about building conviction, the kind that could weather storms. And if you looked closely at those 15 points, you noticed something subtle. They weren't just business questions. They were character questions. Do leaders admit failure? Are they curious? Do they empower innovation or stifle it? Do they invest in the long term or appease short-term investors? Fisher believed that a company's character would ultimately determine its stock performance, because character builds culture, and culture drives action, especially when the road gets rough. And the road always gets rough. Which brings us to another uncomfortable truth Fisher faced. No system is perfect. Not even his. Mistakes will happen. Even the best research can't predict everything. Sometimes a company looks perfect on paper, feels perfect in practice, and still fails. What mattered then wasn't blame. It was the lesson. Fisher wasn't afraid of being wrong. He was afraid of being careless. He knew every mistake held a seed of wisdom if you were brave enough to examine it. He taught his readers to welcome mistakes, not to enjoy them, but to grow from them, to refine their process, to ask better questions, to become more discerning. And in that sense, Common Stocks and Uncommon Profits wasn't just about making money. It was about becoming wiser. Part 4. Over the years, as Fisher's reputation grew, so did the temptation to simplify his methods. New investors cherry-picked pieces of his philosophy. Buy quality, hold long, ignore the noise, but they missed the depth. They missed the soul behind the system. Because what Fisher built wasn't a trick. It wasn't a shortcut. It was a worldview. One where the stock market was no longer a casino, but a window into human behavior, business integrity, and the power of long-term thinking. He often said, "The stock market is filled with individuals who know the price of everything, but the value of nothing." That's what he was fighting against. He wanted people to stop treating stocks like lottery tickets and start treating them like ownership in real businesses. The kind where your decisions mattered, where understanding trumped instinct, where patience beat prediction. And while Fisher rarely chased attention, his influence quietly spread. Even Warren Buffett, a disciple of Benjamin Graham, later admitted his style evolved because of Fisher. It was Fisher who taught him to combine value with quality, to not just look for underpriced assets, but to seek excellence and never let it go. That was Fisher's greatest gift. He didn't teach you how to trade. He taught you how to see through the clutter, how to see the difference between activity and achievement, between motion and momentum, between hype and real, sustained, compounding greatness. He knew the companies that built legacies weren't flashy. They were focused. They were led by people who cared more about doing the right thing than pleasing Wall Street. And when you found such a company, your job wasn't to ride the wave, it was to become part of the tide. But this mindset came with responsibilities. You couldn't afford to be passive. Holding didn't mean forgetting. It meant watching closely, not for price movements, but for fundamental shifts. If a company started compromising its values, losing its talent, ignoring its customers, that was a signal. That was when you reassessed. Because holding wasn't about stubbornness. It was about earned conviction, built over time, reinforced by evidence. Fisher called this constructive patience. You weren't sitting still. You were staying engaged, attentively, wisely, constantly learning. And in doing so, you gained something rare: clarity. Clarity about what mattered, about which signals to trust, about how to avoid the traps of fear, greed, and urgency. He warned that the greatest enemy of investing success wasn't the market. It was you, your impulses, your impatience, your ego. He encouraged investors to build mental defenses, to focus on process over outcome, because in the short run, anything can happen. Markets can misprice, news can mislead, fear can spread. But in the long run, truth always emerges. Companies that deliver value rise. Those that fake it fall. And that's where the uncommon profits come from, not from finding the next big thing, but from staying with the right thing long enough for it to show its power. In the end, Fisher left behind more than a strategy. He left behind a mindset, one that rewards the curious, the patient, the bold, one that says, don't chase the market. Understand it, respect it, partner with it. Because when you stop trying to beat the game and start playing by deeper rules, you don't just win. You change the game entirely. And now, as we reach the final moments of this journey, one truth stands above all. Real wealth isn't just built on strategy, it's built on character. On the discipline to wait, on the courage to dig deeper, on the wisdom to stay when others run. Philip Fisher didn't just give us rules, he gave us vision. A way to see the market not as noise, but as opportunity. Not as chaos, but as pattern. He taught us that the most uncommon profits don't come from speed or speculation, but from aligning ourselves with enduring greatness. So the next time you look at a stock chart, ask yourself, do I truly understand what I'm buying? Do I believe in the business behind the ticker? Would I still hold it if no one else believed? Because that's what Fisher wanted us to learn. Buy what you would be proud to own. Hold it like a partner, not a gambler. And let time do what it always does, reward those who trust the process. And if this review stirred something in you, an idea, a question, a spark, don't let it fade. Explore more, read deeper, and let your investing journey be guided by clarity, not noise. And hey, if you found value here, share it. Subscribe to this channel for more insights that go beyond the surface, that challenge the ordinary, that help you grow not just as an investor, but as a thinker. Because the journey doesn't end here. It's only just beginning.